Have you ever entered a trade only to get stopped out right before the price moved in your direction? You're not alone. The truth is, smart money, meaning institutions and hedge funds, often manipulate price action to trap retail traders. But what if you could spot their footprints and trade alongside them? That's exactly what order blocks reveal. These zones show where big players enter the market with heavy orders. In this video, you'll learn how to spot these zones, understand their logic, and trade with institutional accuracy using order blocks. Let's dive into this powerful smart money strategy. An order block, or OB, is the last bearish candle before a bullish move, or the last bullish candle before a bearish move. This candle becomes a zone of institutional orders, marking where banks or large institutions enter the market. Price often returns to this zone later, reacting sharply. Why? Because big players usually place partial orders, then wait for price to return to complete them. These blocks are not just random, they are zones of imbalance where demand or supply overwhelm the market. Identifying order blocks helps you predict precise entry points based on real market behavior. Order blocks come in two major forms, bullish and bearish. A bullish order block appears during a downtrend, right before a strong bullish reversal. It marks the last selling area where institutions started buying. A bearish order block, on the other hand, forms just before a sharp downward move. It's the last buying candle before the drop. These zones tell us where institutional traders accumulated or distributed assets. Recognizing them can help you predict future reversals and structure-based continuations. Order blocks are powerful because they are based on real institutional activity. Banks and large traders don't place all orders at once, they split them to avoid slippage and control the market. This creates areas of unfinished business or leftover liquidity. When price returns to these zones, institutions step in again, creating strong reactions. Also, these zones often trap retail traders, as they appear just after false breakouts. Understanding OBs allows you to anticipate these traps and trade smarter. It's not magic, it's about understanding the real behavior behind price movement. Let's explore a bullish order block setup. First, identify a market in a short-term downtrend. Then look for a strong bullish breakout candle. The last bearish candle before the breakout becomes your bullish OB. Mark that zone. When the price retraces back into it, look for bullish confirmation like wicks, engulfing patterns, or strong rejection. Enter at the OB, place your stop loss below it, and aim for the next high or imbalance. These setups give excellent risk-reward, especially when aligned with trend and liquidity zones. After marking the bullish order block, don't rush. Wait for confirmation. This could be a bullish engulfing candle, a doji with long wicks, or a shift in market structure on the lower time frame. This confirmation shows that smart money is defending the zone. Enter only when price reacts positively to the OB. This increases your accuracy and reduces false signals. The best OB trades happen when price creates a false low, grabs liquidity, then reverses strongly from the OB, showing true institutional support. Now let's flip the logic for a bearish order block. Imagine the market in a short-term uptrend. Then a strong bearish candle breaks key structure. The last bullish candle before this drop becomes your bearish OB. Mark the zone. When the price returns to this level, watch for rejection or confirmation of selling pressure. Enter short at the zone, place your stop loss above the OB, and target the previous low or the next liquidity level. Bearish OBs are particularly effective in reversal zones, wedges, or overbought areas where smart money unloads positions. Sometimes price breaks through an order block but then retests and respects it from the opposite direction. This creates a breaker block, a smart money flip zone that still offers valid trades. Other times, multiple OBs from different swings overlap in the same zone. This forms an overlapping order block, and the more confluence you have, the stronger the trade. Mark these zones carefully. They often lead to explosive moves when the market revisits them. Always combine them with structure shifts and liquidity for high probability setups. Unlike traditional support or resistance, order blocks represent actual institutional price levels where large volumes were transacted. Support resistance is often based on retail reaction, but OBs are based on smart money entry and exit zones. These zones are more precise and reliable. They act as real magnets for price-attracting pullbacks and providing strong reversal points. When you combine OBs with classic price action, it becomes a powerful strategy that filters out noise and keeps your trades aligned with market makers. Entry into an OB trade should be planned with precision. First, mark the OB zone. Set your entry slightly inside the OB, not exactly at the top or bottom. Place your stop loss a few pips beyond the OB to avoid getting wicked out. For your target, look for the next swing high, previous supply zone, or liquidity level. Always ensure your risk-to-reward ratio is at least 1.2. OBs give small, precise zones, so even a tight stop loss works. Avoid revenge trading and wait patiently for clean OB reactions with confirmation. Smart money loves to manipulate price with liquidity grabs. Before a real move, price often spikes above a recent high or below a recent low to hit stop losses. Retail traders get trapped, and then the market reverses right from an order block. This is where the OB strategy shines. When price sweeps liquidity and then re-enters an OB zone with rejection, it's a high-confidence entry. This combination of liquidity grab and OB reaction is one of the most powerful setups in smart money trading. To boost your win rate, always use multi-timeframe analysis. Identify strong OBs on higher timeframes like 4H or daily, then go to lower timeframes like M15 or M5 for precise entries. Combine OBs with liquidity pools, market structure shifts, and breaker blocks for confluence. A clean trend with a fresh OB and confirmation candle is all you need. Avoid OBs formed in consolidation or choppy zones. The more clean and impulsive the initial move, the more reliable the OB will be when revisited. If this deep dive into the order block strategy helped you, don't forget to like, subscribe, and comment Smart Money Wins down below. This is just the beginning. We'll cover fair value gaps, liquidity pools, and market structure shifts in upcoming videos. Subscribe to Financial Freedom FX and turn on the bell so you never miss smart money trading content again. Remember, trade smart, not hard.